Hello everyone, thank you so much for attending this presentation. My name is Jody Zellner. I'm a financial advisor and the owner of Safe Harbor Financial Advisors, Inc. I'm especially glad you're here because there's no better time to start creating and achieving your financial goals than right now. You'll find it's much easier to manage your money and reach your goals when you have a strategy in place. Financial planning can help you evaluate your unique money situations as they come up and to make the best decisions for your future. Are you ready to get started? Here are some of the general areas we're going to cover today. 1. Millennials and their need for financial planning. 2. Establishing a budget and sticking with it. 3. Managing credit cards wisely. 4. Becoming an investor. And then 5. Taking full advantage of your workplace retirement plan. First, let's talk about why financial planning is important for people in their 20s and 30s. Let's kick things off by considering a few facts and figures about the importance of financial planning for millennials. 3.75 million millennials owe student loan debt. On average, they owe between $20,000 and $40,000. Their home ownership rates lag behind Gen X and baby boomers. Roughly 1/4 of millennials believe they'll be renters forever, and less than 500,000 millennials believe they are on track to hit their retirement savings goals. When you add in the current economic factors like high inflation and rising interest rates, which can make obtaining a mortgage even more expensive, the financial challenges that many millennials face to get ahead become even more challenging. This educational overview will help you become familiar with the basics of financial planning and start taking control of your financial future. It will offer you ways to improve your financial life, whether it's through budgeting, debt management, investment, retirement planning, or some other area. And as you move ahead on in the path to financial wellness, remember that help and guidance is always available to you from Safe Harbor Financial Advisors. Now let's take a look at the foundation of financial planning, establishing a budget. Let's talk about how to establish a budget and stick with it. During this time in your life, you're likely busy establishing yourself in your job or career, building new relationships, enjoying activities with friends and family, and generally figuring out how to navigate through the new challenges and opportunities. There never seems to be enough time to focus on your financial life. However, a budget can help you achieve true financial wellness. This 5-step process can help you create a budget that helps you achieve your financial goals. Let's take a closer look. 1. Define your goals. 2. Know your true income. 3. Know your true total monthly expenses. 4. Create a realistic budget. And then 5. Revisit your goals and expenses. With regards to your goals, your financial goals should be both short-term and long-term. Short-term goals can look like these. Save for vacation. Purchase the latest Apple Watch, upgrade your furniture, saving for a wedding, and a very important one for me, starting an emergency fund. Now for long-term goals, here's some more examples. Buying a home, especially if you're renting, paying off student loan debt, buy a franchise or start a business, build up an emergency fund to cover 3 to 6 months worth of living expenses. Once again, prefer that's a short-term goal, but sometimes that's not always feasible. And retiring early or just setting a retirement date or a retirement amount that what you want to have by retirement. You should write down your financial goals and make sure they're measurable. That means including the actual dollar amounts and time frames for reaching the goals. Here's some examples of measurable financial goals. Build up to $1,000 in emergency funds in 10 months. Pay off $3,000 in credit card bills in 18 months. A little more ambitious, perhaps you want to contribute 8% to the company retirement plan. Or you want to increase your company retirement contributions every January 1st by 1%. For goals similar to the first two, just divide the dollar amount by the number of months in your time frame to figure out your monthly goal. For example, If your goal is to build up $1,000 in an emergency fund in 10 months, your monthly goal is $1,000 divided by 10, which equals a $100 monthly contribution to the fund. Before you can establish a budget, you need to know exactly how much money you have coming in every month from your employer and other sources. Make sure to include only the money you actually receive. That's the exact amount of your net pay, not your gross pay before taxes and other deductions. You can't budget until you know how much money you're spending each month. When figuring out your monthly expenses, be sure to include the following: groceries, rent or mortgage and utilities, entertainment, eating out, credit card payments, student loan payments, car loan payments, cable, Wi-Fi, streaming, your cell phone plan. Also remember to include expenses like doctor and dental visits, insurance payments, haircuts, gifts, manicures or pedicures, and others. It's easier if you look at past bank and credit card statements to get a realistic picture of your spending. To take a stab at your first budget, add your monthly expenses from step 3 to the monthly goals you calculated in step 1. Then subtract that total from your monthly income calculated by step 2. If the balance is positive, you've created a budget that works for your current lifestyle. Here's a current example. Your monthly income from step 2 was $37.50 a month. Your monthly living expenses, step 3, was $2,900. Your monthly financial goals were $700. Your total leftover was $150. That budget will obviously work. If the balance is negative, you have some more work to do. That leads us to step 5. If the first swipe at your budget came out negative, rework the numbers and try again. For example, you can revisit your expenses and decide which ones are a top priority and need to stay in your budget and which ones you can do without. You can also consider changing the amount of time needed to meet your financial goals. Or you can figure out a way to increase your income. Thinking about your goals can give you perspective on how to achieve and how to approach financial planning. Once you have the bigger financial picture sketched out, you can begin to fine-tune the details and develop plans working for each financial goal. Now here's a tactical tip for establishing your budget. Set aside enough money in an emergency fund to cover unexpected expenses. For example, your budgeting might be doing fine for several months before you suddenly need a $750 car repair. It can be hard to get back on track once that emergency is over. In general, you need to have 3 to 6 months of living expenses and an accessible savings account. Keep in mind that emergency savings are for just that, money to be used for an emergency. It's critical to avoid using a credit card when an actual emergency comes up, and then having to pay the interest when carrying a credit card balance. It's okay to use these emergency funds and then start rebuilding those funds again. That's what they're used for, an emergency. Now let's talk about how to manage credit cards wisely. Now I'd like to talk about something very closely connected to the success or failure of your budget, the need to manage credit cards wisely. Without a debt, credit cards make life more convenient, but not necessarily easier. This is often your most expensive debt. If you use them too much, they become the biggest obstacle to reaching your financial goals. When using credit cards, consider these valuable tips. 1. Review your statements regularly to keep track of your purchases. 2. Pay your bill on time to avoid less charges. 3. Pay off the full balance every month when possible to avoid paying interest. 4. Take advantage of the rewards programs. And 5. Protect yourself against credit card fraud by putting a freeze on your credit bureau records. And now some bad habits to avoid. 1. Using a credit card to make ends meet. 2. Using several credit cards at one time. 3. Not researching other options before applying. 4. Exceeding 25% of your credit line. 5. Using rewards programs as an excuse to buy more stuff. And 6. making large purchase items unless you can pay off the balance quickly. Now that you have some good tip on managing your credit cards, I'd like to talk about the importance of maintaining a good credit score. Your 3-digit FICO credit score is one of the most important measures of your financial wellness. Each major credit bureau in the U.S., Experian, TransUnion, and Equifax, uses FICO's technology to calculate a FICO score for the borrowers. Your credit score affects your life in more ways than you may realize, so it's really important to know what goes into that number. Having a lower score can keep you from qualifying for a mortgage or a car loan. It can also mean you have to pay very high interest rates to qualify for a credit card. The better your credit score, the more likely you are to be approved for a loan and receive more favorable interest rates. Potential employers and landlords also check your credit score. One way to make sure your payments are on time is to set up automatic payments or set up electronic reminders. If you miss payments, get current and stay current. To learn more about how to improve your FICO score, go to myfico.com/credit-education. Now let's talk about becoming an investor. I think we've talked about the challenges of spending money for now. Let's turn our attention to something more exciting. One of the biggest opportunities you have to build personal wealth and financial wellness is through investing. But how do you know when you're ready to take the plunge? Since investing always includes some risk, it's important to have a solid financial foundation before you begin. Here are some key things to make sure you have covered to make sure you're ready. 1. You have a steady income. Sounds obvious, but it's important. 2. You have money left over after meeting your financial obligations, a budget. 3. You've considered the effect of upcoming personal changes such as marriage, children, or divorce before investing. 4. You've built up your savings, including that 3 to 6 month emergency fund before establishing an investment account. A stock, also known as equity, is a type of security that signifies an ownership in the issuing corporation. This entitles the stockholder to that proportion of the company's assets and earnings. Stocks are bought and sold predominantly on stock exchanges, and they are the foundation of nearly every portfolio. Stocks and stock mutual funds and electronically traded funds, called ETFs, have a higher potential return, but the potential risk can also be high. They are typically considered as part of a long-term financial goal, like retirement, where you have time on your side and can afford to be more aggressive and take more risks. They usually do not make sense for funding a short-term financial goal where safety and stability are more of a priority. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders, creditors of the issuer. Bond details include the end date, when the principal of the loan is due to be paid off to the bond owner, and usually includes the terms for which interest payments are to be made by the borrower. Bonds and bond mutual funds are known for consistent, moderate terms, which may be work best for funding medium-term financial goals, where you can take on some risk, but not a lot of risk. In addition, as you get closer to retirement, within 10 years in general, bonds and bond funds may become a bigger or the biggest part of your retirement account portfolio if you are looking to reduce risk but still want some potential growth and income. Cash equivalent investments are typically money market funds and can include U.S. Treasury bills as well. They are known for consistent lower returns with much lower risks that may make more sense for shorter-term financial goals, such as saving for a wedding or vacation. As you get closer to retirement, generally within 5 to 10 years, cash equivalents may also become a bigger part of your retirement account portfolio if you are seeking more safety at this life stage. By diversifying your investments, you are reducing the amount of risk you will incur since you're not putting all of your eggs in one basket. Different investments have different risks involved with them. For example, stock or bond mutual funds may be considered riskier than putting your money in a money market fund, However, the mutual funds will generally have higher returns. By diversifying your portfolio, you can reduce the amount of risk you're exposed to while seeking to maximize your returns. Professional help is available if and when you need it. Safe Harbor Financial Advisors can give you a hands-on personal guidance to help you determine your retirement goals and how to work toward them. They can help you understand different types of investments and their place in a balanced investment portfolio, help you to determine your financial goals such as retirement, buying a home, funding for a college education, starting your own business, or just getting better at budgeting and paying down credit card debt. Help you determine an appropriate investment strategy for your financial goals based on your risk tolerance and time frame. Discuss professionally managed investment strategies that may be of interest to you. And meet with you on a regular basis to track your progress and adjust the plan as necessary. Now let's talk about the benefits of your workplace retirement plan. One of the easiest ways to become an investor is by participating in your employer's workplace retirement plan if one is offered. For most of you, that will be a 401k plan. If you work in healthcare or nonprofit organization, it's called a 403b plan, which is very similar to a 401k plan. There may not be a bigger or better opportunity to achieve financial wellness than a workplace retirement plan. There are 6 major benefits to participating in such a plan. Let's take a closer look. The first major benefit is that your savings are automatic. With a plan such as 401k, your money is deposited from your pay to your account without you even having to think about it. It doesn't get much easier than that. In addition, the amount contributed to your retirement account reduces your taxable income, which lowers your tax bill. Let's take an example of a worker earning $50,000 who's in the 22% tax bracket and saves $5,000 in their retirement account each year, or 10% of their salary. They're reducing their tax bill by $1,100 each year, $5,000 by the 22% income. Income tax won't be due on this money until it is withdrawn from the account. Number 3 on our list is tax-deferred compounding. Compounding happens when your net investment starts earning interest, dividends, and/or capital gains. Those earnings get added to your initial investment, and then they start earning interest too. So now you're earning interest on interest. That's compounding. Investments with earnings that are tax-deferred have the potential to grow even faster when they're not being reduced by taxes each year. Number 4 on our list is free money courtesy of your employer match. You should try to save enough to get your full employer match, subject to your plan's vesting rules. A common employer match is 50 cents for each dollar you save in the plan up to 6% of that pay. That's a 50% return on your investment. A dollar for dollar 401k match doubles your money. Benefit 5 is your money goes where you go. If you leave your employer for any reason, you can take your balance, including the invested amount of the employer match, with you. You can roll it into an IRA or a new employer plan if allowed. And finally, we have account management made easy. Your plan's record keeper provides you with comprehensive account access where you can view your balance, perform transactions, and talk to a call representative for guidance. On top of that, you can view retirement planning education materials and calculators, and likely even model various saving scenarios and assumptions to help you gauge your progress towards retirement readiness. Your retirement accounts have unique tax implications. A traditional 401k uses pre-tax dollars, lowering your tax burden while you work. However, you'll pay income taxes when you withdraw the money from your account during retirement. On the other hand, a Roth 401k contribution comes from money that you have earned that has already been taxed. You pay 0 taxes on withdrawals from this account when you're retired. In general, a Roth option may be a more favorable saving strategy for younger adults. At this stage in your career, you're likely earning less today than you will in the future. That means you're in a lower tax bracket and paying lower taxes now. You might consider taking advantage of that now. Of course, no one knows what the tax brackets will be in the future, so you could decide to diversify your contributions evenly between the traditional and Roth. Many employers offer this option to their employees. Depending on your circumstances, you can always decide to go heavier towards one option versus the other in the future. Your workplace retirement plan offers a number of appropriate investment options for you to choose from. That usually includes individual mutual funds representing all the major asset classes, as well as pre-mixed portfolios that you can match up with your own personal tolerance for risk and timeline to retirement. Another likely option available to you is a target date fund. A target date fund is a mutual fund that invests with the assumption that investors will need to start withdrawing money from the fund at a specific time in the future. A professional fund manager monitors the fund and makes adjustments to the underlying investments as needed for the time frame. The primary feature of a target date fund is that the fund adjusts its risk level over time. When the target date is still far away, 2055 for example, target date funds invest in more of their total assets in higher risk investments like stocks, with little or no exposure to more conservative investments. As the target date approaches, the fund gradually shifts its asset allocations away from the stocks and other riskier assets in favor of bonds and other conservative income-producing investments. An individual retirement account, IRA, traditional or Roth, is a tax-deferred retirement savings account typically established by someone who is employed and doesn't have access to a workplace retirement plan like a 401k. IRA accounts are held by custodians such as banks or brokerages. Unlike 401ks, IRAs allow account holders to choose from a much larger universe of choices that include stocks, mutual funds, ETF funds, bonds, treasury bills, and CDs. Like 401ks, contributions to traditional IRAs are generally tax deductible. Earnings and returns are tax deferred, and you pay tax on qualified withdrawals in retirement. Contributions to a Roth IRA are made with after-tax dollars, and withdrawals are tax-free in retirement. The annual contributions limits for traditional and Roth IRA changes every year. We're coming to the end of this presentation. I'd like to wrap up with just a few other areas to keep in mind when it comes to financial planning. The first is executing essential legal documents. Here are the 4 documents we need to consider for now. 1. A will. A will outlines how your property should be divided at your death and designates a person responsible for handling the details. Without one, the courts will make that decision according to state law. 2. A living will, aka advance directive, outlines preferences for treatment if you face a serious medical situation and if you need machines to help you stay alive. A medical healthcare power of attorney is often part of a living will. It designates a person to make medical decisions for you if you are incapacitated. And finally, a durable financial power of attorney designates a person to make financial decisions to you on your behalf if you are unable to do so at some point in time. Now I'd like to briefly touch on insurance coverage. When it comes to property and casualty insurance, it's a good idea for younger adults to consider talking with an insurance professional to help them decide on what the most effective car insurance coverage, as whether or not an umbrella policy is needed. Renters should also purchase renter's insurance, as it can limit their renter's liability if someone sues due to a personal injury or damaged property. As for life insurance, in general, it gets more expensive with age. Term insurance for a young, healthy person is relatively inexpensive and a good idea if you have debts that will need to be paid if you die unexpectedly or if you have a family to provide for. Your employer may offer disability insurance, which comes in handy if you get ill or injured and cannot work. Okay, we've come to the end of the presentation. You've been a fantastic crew. Thank you so much for your time and participation. I would just like to leave you with one tactical tip. I am here for you if you need me. Financial planning can be intimidating. I get that. There's a lot to learn and a lot to keep in mind, especially when it comes to investing and retirement planning. It's likely that at this stage in your life, you don't need a full-blown financial plan, but you may need help here and there on certain aspects of your financial life, especially getting started with retirement planning. As an example, I can help you determine your retirement savings goal and how you can achieve it. That includes helping you decide between a Roth and a traditional contribution, creating and monitoring your investment strategy, and balance your retirement savings goals with other financial goals. If you're interested, I would be glad to talk to you more about this at your convenience. Thank you for your time. I'm happy to answer any questions you might have right now.